Funding for Building New York is provided by First American Title Insurance Company of New York.
Welcome to Building New York. My name is Michael Stoller. In 2004, many people said that the Rockefeller Center of the 21st century was created. There were a number of individuals and organizations responsible for the creation of the Time Warner Center. Today, my guest is Lee Neibart, Senior Partner at Apollo Real Estate Advisors, one of the partners and the developers of the Time Warner Center. Thank you for being here.
How are you, Michael?
Lee, you grew up in Orange, New Jersey. You were one of two children. Your father had a hardware, furniture, multi-purpose store. You go to University of Wisconsin with a political science degree. The reason that you wanted to be a political science degree?
I had an interest in presidential politics, and I thought it would be the easiest program I had to get through for 4 years.
So it's 1972, and what do you do then?
Well, the war was going on. My lottery number was 180, which was right on the edge in those years. And I had decided to postpone going to work for 2 years, so I applied to New York University in their graduate school of business, hung out there for 2 years. I graduated, and war was over, and then it was time to go to work.
So 30 years later, you build this with your partners, this property, and as you told me the other day, you found an ad in the New York Times, and what was the job for?
Well, it was interesting. I graduated in May of 1974, and I did not exactly rush out to get my first job. And in September of '04, there was an ad at the Prudential insurance company. They needed an analyst to program their recent holdings in new acquisitions, since they had only been a lender. So they decided to get some bright young man who they thought had extensive computer programming skills in order to put this program together.
Did you understand anything about computers at this time?
I didn't have the faintest idea about computers. All I know is that I needed a job.
So from the New York Times job, you went to work in Newark?
I started in Newark, yes, at the home office.
And how did you end up in the real estate business at Prudential?
Well, this first job was in the real estate division. So I figured that once in the door, I could start to figure out my way how to get out of the computer programming job. So that was on the 20th floor, and all the big shots were on the 16th floor. So I used to make sure that I was in there early.
And you were tall enough.
And I was tall enough. And I made sure that I was in there early and asked, were there any other tasks or jobs or things that they had to be done. So quickly they took a liking to me, realized that I didn't know the first thing about computers, and then they put me to work as an analyst looking at new types of acquisitions, development deals. So that was about 3 months of figuring out the system.
And you spent 5 years at Prudential.
Yes.
And that was in New Jersey. You were living in New Jersey at this time?
Well, the first 2 years were in Newark, and then I transferred to the New York City office.
It's 1979. The real estate economy is not the best at that time, and you you find an opportunity up in
Westchester,
Elmsford?
yes.
What was the job? What happened? Where'd you go?
Well, just one interesting story why I did leave was, which we didn't talk about, was that previous to that, at Prudential, I had worked for 6 months on the acquisition of what became the Olympia and York portfolio, the single greatest buy in the history of.
Are we talking about this portfolio?
We are talking about that portfolio, 55 Water Street, 2 Broadway, 245 Park Avenue, the greatest office buildings in the world. And I had spent a great deal of time working on
So
the
this
acquisition
was the
of it.
Reichman family from Canada, the
Yes.
Olympia in New York. They were acquiring this from a variety of families. Who
Well,
was
it was mostly the Urus
the
family.
Urus family,
Right.
and Prudential financed this.
No, they had to be the buyer. And after spending 6 months working on it, it went to the Board of Trustees at Prudential, who on a vote of 5-4 voted against the acquisition. So they felt that the exposure to New York City was too great, and they felt that Prudential had owned too much real estate in the city of New York.
Which is rather interesting because Prudential was the forerunner of Times Square.
Yes, but that was a generation before Times Square. So the opportunity to acquire a portfolio of about, I forgot how many square feet, but it at $50 a square foot, which is arguably worth today over $650 to $700 a foot. At that point, I was very disappointed because this was an acquisition that should have been made, and it was then at that time that I decided to leave Prudential.
And you went to, at that time, I think it was in the early 70s, people were abandoning the city.
Yes.
And they wanted to go, everybody wanted to go to the suburbs. And at that time, you went to a major suburban company, the Robert Martin Company.
Yeah. Well, at that time, there were really only 3 major developers in Westchester: Robert Martin, Lowell Shulman, and Joel Halpern. And I had done my homework, and Robert Martin owned and controlled major tracts of land in Westchester County, whether it was Yonkers or Mount Pleasant or Tarrytown or White Plains or Elmsford. It was an organization that didn't have to go out and find deals. They controlled over 300 acres of land. So there was no question in my mind that for the next 8 to 10 years, the company had the ability to build 300,000, 400,000, 500,000 feet a year.
And they built office, residential, hotels,
Industrial, retail, and what they call flex space.
and you spent from 1979 to 1993, and you saw, as we always see in the real estate cycle, a couple of ups and downs.
Yes.
And I think one of the biggest ups or the biggest downs that they said is you saw Westchester at a 30% vacancy factor.
And it was a factor in that I did not see any way that Westchester would organically grow out of its problems. Westchester is a very expensive place to live. Real estate taxes are high, and the major companies such as IBM and Texaco and AT&T and General Foods were all discovering that they were unable to pay their employees in those years what they needed had to be paid in order to take care of their family. That resulted in relocations, General Foods leaving, Texaco leaving, IBM downsizing, and all across the board from Rye to Tarrytown. And it was something that concerned me because clearly I did not see any way of regrouping this.
Now, the interesting situation is from 1987 till today, there really hasn't been a new office building or an industrial building in Westchester.
Well, I was right. I mean, it was not hard to figure that there would always be this 15 to 20% systemic vacancy rate. And if you have that type of space available, you'll never be able to build a new building. And it was very competitive, and it was very hard to retain your tenants.
It's 1993. Now you have 5 years of experience with the Prudential. You have 14 years. You're an executive vice president and a principal, to a point of a principal of ownership
Right.
of Robert Martin. And you decide to take a leap. You're 41 years of age?
43.
You're 43 years of age. Tell us about that leap.
Well, it was an interesting story, and one which I'll never forget. I'll tell you a little anecdote that when I decided to take this leap, we had a big family meeting in the living room, and I called my 12-year-old and 10-year-old together with my wife, and they, of course, loved going to Robert Martin because everybody took care of them. And I said, I don't know how to tell you this, but I'm leaving Robert Martin and I'm joining another company. To which my son said, do we have to move? And I said, no. He says, well, hop back to homework and watching television. So it didn't concern him because it didn't change his life.
But that was a change because now you went to, you became a principal
Right.
at a startup in certain aspects. I mean, Apollo Real Estate Advisors, who had, your partner Bill Mack had been in the real estate business for his entire career, and his family had been in it. But you had not. It was a totally different type of business.
It was an opportunity fund. It was the second opportunity fund started behind Whitehall. So there was not a whole lot of information about opportunity funds, how they operate, how they share profits, how management fees are collected. So it was really on-the-job training for me. But when I met with Bill and he offered me the job, what was important was that the money had been raised. There was $500 million in the bank. And I was there about 6 months after it started. And it was amazing because I looked at the first 6 or 7 deals that Apollo Real Estate had done. And it was clear to me that we were at the beginning of a tremendous opportunity, in that the crisis in the real estate market ran from Boston to San Francisco. It was over-leveraged, under-rented, and banks were foreclosing, and banks wanted to sell their positions at cheap prices. And I could see the way that our guys were making their deals, that it was the beginning of a tremendous opportunity.
Let's talk a little bit about the Time Warner Center. I mean, it literally, it's 3.45 acres.
It is.
It's 2.8 million square feet.
On a gross basis.
On a gross basis. You have a vertical retail, which was a failure every time in New York City.
Was.
You have condominiums. You have a 5-star Mandarin Oriental hotel. You have jazz at Lincoln Center. And you have, more important, you had a place that was basically vacant, the Coliseum, with an office building component, which was a failure,
Right.
for 15 to 20 years. How Related and Apollo get together and were creative enough to build this $2.8 billion edifice, which really is the rock center of the 21st century?
What a lot of people don't realize, everybody said how risky it was, how reckless it was, how you were...
Did your hair turn gray during this period
Yes,
of
it
time?
did, actually. That we were gambling the investors and our own money away on an ego project. And that was some of the criticism. If you analyze and slice through the project, it is not nearly as risky as people on the outside seem to think it was. What do I mean by that? We had a purchase takeout from Time Warner for their 900,000 square feet, which is an interesting story, because when the deal was made, it was a purchase. It was an outright purchase. Others said, well, why didn't you make a lease with AOL Time Warner? And we said, well, here we think the less risk is to enter into a purchase option. From the time that we did that, 2 years later, AOL and Time Warner made their merger, and there was no rule that said AOL Time Warner would ever survive as a company. But what we had was a firm, bankable takeout backed by the Bank of America that upon completion of the Time Warner phase of this complex, we would get paid.
You would be paid for the office component.
For the 900,000 square feet that Time Warner would occupy.
Now, but if we look back, in 1991, there were hopes that perhaps there would be a Kmart.
Yes, that's right.
A sports authority, a Borders.
Right.
There were all these different discussions. And then Mort Zuckerman had bid $450 million, and then there was the MTA and all of this. Would you say that this project really couldn't have taken place if Time Warner hadn't committed to taking this 900,000 square feet?
In hindsight, I'm not sure that we ever would have got it financed.
Yes, there hadn't been new buildings. This was, we had gone into a crisis that, with the exception of the Times Square
which was
buildings,
a debacle.
Which was a debacle for 15 or 18 years, there hadn't been any new office building construction for a period of time.
Because remember, on a project cost of $1,700,000,000, Time Warner's portion of it was about $650 million. So now, from $1,700,000,000 minus $650, your risk is now $1,050,000,000.
Yeah,
so,
but you also had the other situation in many developments in New York City, Lower Manhattan, even portions of Times Square. You were able to get tax abatements or industrial credits. You guys went in there without any tax abatements, as we would say, 421As, where you all of this, and you had these condominiums, which are magnificent, and this hotel. And you had this really big problem. Trump's property had been a failure. The property, Manhattan Mall, was a failure. I mean, were you a little nervous at that time?
I was, and it was interesting. The day after we closed the construction loan with GMAC, which was a major relief.
It was the biggest construction loan they had ever done in their life, $1.1 billion.
$1.3 billion. It was had the single largest one, which is a whole other story, and I'll tell your listeners that the underbid,
the viewers here,
that the second bid was about $1 billion. So from $1.3 billion to $1 billion, that's an awful lot of equity that GMAC covered. But the day after the construction loan closed, we were very, very relieved that component of it was over, because we still felt at that point that the $1.3 billion against the Time Warner takeout, and we also had a deal with Mandarin Oriental, where they contributed half of the equity. So
for their hotel portion.
For their hotel. And we felt there was enough retail, and we also had the central parking lease. We also felt that there was enough retail buildup of interest on the concourse level, which went to Whole Foods, Elizabeth Arden, Equinox, and the others, that we would be okay. So it really boiled down to, after we caught our breath, we had our construction loan closing, we had our guaranteed maximum price, we were underway, it really came down to, could you sell 450,000 square feet or 200 condominiums? That was the key to this whole deal. And in hindsight, that was the real gamble.
Now, many people, including this host, was very suspicious and felt that very few people would run to the retailers over there or really flock, because it wasn't a neighborhood for this. What's happened?
Well, just one point before I answer that, which was also interesting, that we closed the construction loan. after we had demolished the old Coliseum in the office building, started building, started drawing down on the construction
Which is
loan.
interesting that your partner, Bill Mack's father, in 1950, when he was 12 years of age, in 1952, went there, and his father owned the property, and he demolished. So it was a watching of the redemolishing.
Yes, Bill was very proud the day that we had the topping out that he could talk about his father and how he used to go with him on the job. And as Bill said, his father got a bonus from Robert Moses for actually having the construction of the building done ahead of schedule, and very few people got a bonus from Robert Moses. But the point I was going to make was the other point that is not spoken of is that we topped out around 9/11. So as horrible and horrific as 9/11 was and is, it was just another potential problem for this project. The iron workers went downtown as they should have. The job stopped, and we were never really sure if we were able to regain the momentum on the sale of the condominiums, because most of the contracts that we had were dropped. People just were not comfortable at that specific point in the fall of '01 having a contract to buy an apartment in a tower this size. But I think the key aspect of the retail, and all of us can say that we always knew, but I don't think so, was of course Whole Foods. It was something that just has been the magnet to the retail center, continues to do extremely well, brings the people in, and that was the key lease, in my opinion.
Apollo has been involved recently with a number of other real estate activities, and you, being in your position as chief investment officer, head of the committee, have done these things. You're in the middle of developing a condominium about 2 blocks from the Time Warner Center.
On West End Avenue. My smarter partner, Richard Mack, figured out that the old Gasoteria site was available, had a little cleanup that he had to do. One of the sellers had to remain in the deal, and he was able to buy it at an extremely attractive price in relationship to what's happening across the street.
So that's on West End Avenue,
Yes.
on 60th, 61st Street.
Right.
And then you did another deal on 505 Greenwich Street.
We did, and that was an interesting deal too, which only goes to show it's good to have younger partners. I went down there one night with Richard and the gang, and I said, who would ever buy an apartment just south of a UPS trucking terminal and the Holland Tunnel? So he said, you don't understand, this is an emerging area, and he was 100% right. And that was one of the biggest successes now that we've had over the last
And you're building
3 or 4
another
years.
property a couple of blocks away, right?
On Hudson Street, which is doing very well. So we like these types of areas.
And you're also doing a project in Brooklyn, in Cobble Hill?
In Carroll Gardens.
Carroll Gardens.
Right, which was an interesting deal because you can imagine the price appreciation in Carroll Gardens. If you had checked the records, the deal that we bought had been sold 3 or 4 years earlier for $12 million and then $25 million, and we thought that it had a very good possibility of being converted. So we paid more than $25 million, and that's proven to be very successful.
And now you've really made a major commitment to the urban neighborhoods, to rental. I mean, these other projects that you just mentioned are all condominium conversions.
Right.
In December, you bought the Soundview up in the Bronx on 31 acres.
Right.
And now, later this month, you're closing in Harlem on Delano Village.
In 2 weeks.
And what's what's Apollo's feelings of why you're getting involved with these type of properties?
Well, we just think that it's interesting. We've owned over the last 12 years properties such as 1296th Avenue, 535, 545 5th, 757 3rd, 300 Park Avenue South. We own them, we did very well with them, and now it's a time for other people. We believe with our studies that these properties have been underloved, not necessarily mismanaged, but in need of aggressive property maintenance, property management, and we have the opportunity to increase the rents on these properties. And as a judge against replacement cost, when you're able to buy a unit, when we're able to buy a unit in the Bronx for under $50,000 a unit, and for and under $100,000 on 131st Street, we just think that this is a very good place for us to be investing. We have the skills. What's important is that most of us have grown up in the real estate property business, so we think that we can turn an awful lot of these rentals into higher rentals by giving the tenants the proper service that they're entitled to.
I think, Lee, with your 32 years of experience,
it can't be that long now, can it?
What you've done, with the Time Warner Center, with all of the residential and all of the components. I didn't even have a chance to discuss the two projects that you're doing in Long Island, the one in Hicksville and the Lake Success. You're truly a builder of New York, and I'd like to thank you for being here today.
Thank you, Michael. It's been a pleasure.
Funding for Building New York was provided by First American Title Insurance Company of New York.